This might sound counterintuitive, but the collapse of a major financial institution right now might be the best thing that could happen to your silver position. I know how that reads. Most people see bank failures and think chaos, panic, systemic meltdown. And yeah, there's some of that. But what we're witnessing isn't just another isolated incident. What happened this week represents a fundamental crack in the facade they've been desperately maintaining since 2008. And when I say they, I'm talking about the central banking cartel that's been running this game for decades. Republic First Bank just went under. You probably didn't see it trending on social media. The mainstream financial press buried it on page 7, right next to the car advertisements. That's intentional. They don't want you connecting what is happening in regional banking to what is about to explode in precious metals markets. But here's what actually went down, and why it matters more than anything Jerome Powell said in his last press conference. Republic First wasn't some tiny community credit union in rural Montana. This was a billion-dollar institution operating across multiple states. They had real assets, real deposits, real relationships with commercial clients. On paper, everything looked stable enough. Their quarterly filings showed the standard reassurances. Management was issuing confident statements about their position just weeks ago. Then, Friday afternoon, the FDIC walked in and seized the whole operation. Complete takeover. Depositors woke up Monday morning to discover their accounts had been transferred to Fulton Bank. Just like that. No warning, no negotiation period, no chance for management to implement a turnaround strategy. That speed tells you something critical about what regulators are seeing beneath the surface of the banking sector right now. See, when a bank fails in 2025, it's not because they made one bad loan or hired an incompetent risk manager. The underlying disease is systemic. It's baked into the very foundation of how modern banking operates. And that disease has a name: duration risk combined with deposit flight, all happening in an interest rate environment that makes the 1980s look tame. Let's explore what happens next, because this isn't an isolated event, and anyone who tells you otherwise is either uninformed or lying to protect their position. Republic First Bank is the second FDIC-insured institution to collapse in 2025. We're barely into the year. Last year, we saw the failures that actually made headlines: Silicon Valley Bank, Signature Bank, First Republic. Those created enough panic that Treasury and the Fed had to engineer emergency backstop facilities that technically violated their own rules. They called it protecting depositors, but what they were really doing was preventing a 1930s-style cascading collapse. But here's what they didn't fix: the fundamental math problem destroying bank balance sheets across the country. Every bank holds assets, primarily loans and securities. Most of those securities are Treasury bonds and mortgage-backed securities, stuff that regulators consider safe. When interest rates were near zero from 2008 through 2021, banks loaded up on long-duration bonds yielding maybe 1%, 2% if they were lucky. That was the game. Borrow short, lend long, collect the spread. Then Powell's Fed jacked rates from 0 to over 5% in the most aggressive tightening cycle in modern history. Every single one of those safe bonds sitting on bank balance sheets got absolutely demolished. A 10-year Treasury bond yielding 1.5% that was worth $100,000 at par might be worth $70,000 on the open market when rates hit 5%. The math is unforgiving. Now, under normal accounting rules, banks don't have to recognize those losses until they actually sell the bonds. They can hold them in an available for sale or held to maturity category and pretend everything's fine. The unrealized losses just sit there in footnotes that nobody reads. But here's the crucial part. Those accounting games only work if depositors keep their money in the bank. The moment depositors start withdrawing, maybe they're getting nervous about bank stability, maybe they're chasing higher yields in money market funds, maybe they just need cash because the economy's turning. The bank has a problem. They have to raise cash to meet redemptions. If their loan book is illiquid, they're forced to sell those underwater bonds at massive losses. Once they start realizing those losses, capital gets wiped out. When capital hits certain thresholds, regulators step in. That's exactly what happened to Republic First Bank. According to people familiar with the situation, they were experiencing sustained deposit outflows for months. Management tried everything: raising rates on deposits, cutting costs, attempting to find a merger partner. Nothing worked. The outflows continued. Eventually, they had to start liquidating securities at losses. Those losses ate through capital buffers. By the time regulators showed up, there was no saving it. And here's the thing that should terrify anyone paying attention. Republic First Bank is not unique. The FDIC's own data shows the entire banking sector is sitting on approximately $500 billion in unrealized losses on securities holdings. $500 billion. That's not a conspiracy theory, that's straight from regulatory filings. Most of those losses are concentrated in small and mid-sized regional banks. the institutions that don't have diversified national deposit bases or trading operations to offset the carnage. They're stuck holding these underwater bonds, watching deposits slowly bleed out, praying that nothing spooks their remaining depositors into a run. Now, let's connect the dots between banking sector stress and what's about to happen in silver markets. When banks fail, confidence in the financial system evaporates. Not all at once. This isn't a Hollywood disaster movie. It happens gradually, then suddenly. People start questioning whether their deposits are truly safe. They start looking for alternatives. And historically, when confidence in paper financial assets and institutions declines, precious metals catch the bid. Gold gets most of the attention because it's the traditional safe haven, the asset central banks hold, the thing your grandfather told you about. But silver? Silver is where the real explosive potential lives, and most investors are completely blind to what's building. The silver market is tiny compared to gold. Annual silver production is around 800 million ounces. That sounds like a lot until you realize the entire above-ground investment-grade silver stock globally is estimated at maybe 2 to 3 billion ounces. The total value of all the silver in the world available for investment is smaller than the market cap of many single tech companies. This creates a fundamental supply-demand dynamic that doesn't exist in gold. When investment demand surges into silver, there's nowhere near enough physical metal to satisfy it. The market is structurally tight, even under normal conditions. During periods of financial stress, it goes absolutely parabolic. Look at what happened in 2011. Silver went from $18 to nearly $50 in a matter of months. That wasn't because of industrial demand or jewelry consumption. That was pure investment panic buying, people fleeing the dollar and the banking system, searching for tangible assets outside the financial system. We're setting up for a similar move, except this time, the underlying conditions are far more extreme. Mark my words on this. The commercial banks and bullion banks who've been suppressing silver prices through paper derivatives, markets are about to lose control of the situation. For years, a small group of institutions has dominated silver trading on the COMEX futures exchange. We're talking about maybe 4 or 5 banks holding massive concentrated short positions. They've used these paper positions to cap price rallies, create artificial selling pressure, and generally manipulate the market to their advantage. This isn't speculation. Banks have paid hundreds of millions in fines for precious metals manipulation. JP Morgan alone paid nearly $1 billion in 2020 for spoofing metals markets. But manipulation only works when the manipulators have unlimited financial resources and confidence in the broader system. When banks start failing, when balance sheets are under stress, when liquidity becomes precious, maintaining massive short positions in a rising market becomes suicidal. Here's how this typically unfolds. As silver prices rise, those short positions generate losses. Banks have to either post more margin or cover the positions by buying silver. That buying creates upward price pressure. The higher the price goes, the more shorts are forced to cover. It becomes a self-reinforcing squeeze. And right now, we have something we haven't seen in decades. Physical demand so strong that it's disconnecting from paper markets. Retail demand for physical silver coins and bars is absolutely bonkers. The U.S. Mint has struggled to keep up with Silver Eagle demand. Premiums, the amount you pay above spot price for physical metal, have been running at $3 to $5 per ounce. That's insane. In normal markets, premiums might be $1 or $2. What that tells you is that people don't trust the paper price. They're willing to pay significant premiums just to hold actual metal in their possession. That's a sign of deep structural distrust in the financial system. At the same time, industrial demand for silver is accelerating. Solar panel production requires silver. Electric vehicles use more silver than traditional cars. 5G infrastructure, medical applications, water purification. Silver has legitimate industrial uses that create baseline demand independent of investment flows. So you've got tightening physical supply, surging industrial demand, increasing investment demand from people spooked by bank failures, and a paper derivatives market where commercial banks are sitting on massive short positions they may not be able to maintain. This is where it all connects. When Republic First Bank failed, it didn't just hurt depositors or create a local problem in Philadelphia. It confirmed what many of us have been warning about for years. The banking system is fundamentally unstable, built on a foundation of unrealized losses and mismatched durations that can't survive in a rising rate environment. Every additional bank failure accelerates the loss of confidence. Every emergency intervention by the Fed or FDIC reminds people that the system requires constant life support. Every reassuring statement from Janet Yellen or Jerome Powell sounds more desperate and less believable. And as that confidence drains away, the capital has to go somewhere. Some will flow into Bitcoin and cryptocurrencies. That's already happening. Some will chase real estate, though property markets are rolling over in most regions. Some will sit in treasury bills, accepting minimal returns in exchange for perceived safety. But a meaningful percentage, even if it's just 2 or 3% of the panicked capital, will flow into physical precious metals. And when that capital hits the silver market specifically, the fireworks begin. Let me give you some numbers to make this concrete. The entire global silver market trades maybe $30 to $40 billion worth of metal annually through all channels: mining production, recycling, industrial consumption, investment demand. That's the whole enchilada. Now compare that to the money sitting in just US money market funds right now, over $6 trillion. $6 trillion with a T. That's money earning maybe 4 to 5%, sitting there waiting for the next crisis, ready to move at the first sign of trouble. If even half of 1% of that money, $30 billion, decided to buy physical silver as a safe haven during a banking crisis, it would overwhelm the entire annual global market. There literally isn't enough metal available to satisfy that demand at current prices. Prices would have to rise dramatically and quickly to ration the available supply. We're talking about potential moves of 50%, 100%, maybe more, over a compressed time frame. And here's the thing they don't want you to understand. Rising precious metals prices create a negative feedback loop for the banking system and the Fed. When gold and silver prices surge, it signals to the world that confidence in fiat currency and central banks is collapsing. That creates more pressure on banks as depositors panic. It forces the Fed into an impossible choice: keep rates high to fight inflation, and watch more banks fail, or cut rates and backstop the banks, while admitting inflation isn't actually under control. Either path destroys the narrative they've been selling. Either path accelerates the move into hard assets. The Fed's worst nightmare is a scenario where inflation remains elevated while the banking system crumbles. They can't cut rates enough to save the banks without reigniting inflation. They can't keep rates high enough to kill inflation without collapsing the banks. It's a trap of their own making. And precious metals, especially silver, become the barometer that exposes the whole charade. Now, I want to be clear about something. I'm not saying bank failures are good. They're not. People lose jobs, businesses lose credit lines, communities lose institutions. It's destructive and painful and represents a massive failure of policy and regulation. But if you're an investor trying to navigate this environment, you have to recognize reality as it is, not as you wish it to be. The reality is that the banking system is fragile. Republic First Bank won't be the last failure. The unrealized losses are still sitting there on balance sheets across the sector. The deposit flight dynamics haven't been resolved. The interest rate environment remains hostile to traditional banking models. More stress is coming. More failures are probable. More emergency interventions are inevitable. And each one of those events pushes more capital toward the exits, searching for safety outside a system that's increasingly recognized as unstable. Silver represents one of the most asymmetric opportunities in that environment. The downside is relatively limited. Industrial demand provides a floor, and at current prices around $25 to $30 per ounce, most miners can still produce profitably. The upside is potentially enormous if even a fraction of panicked capital flows into physical metal. Let me give you a historical parallel that might clarify where we are in this cycle. In 1979 and 1980, the United States was dealing with high inflation, a weak dollar, and collapsing confidence in federal institutions after Vietnam and Watergate. Paul Volcker at the Fed was jacking interest rates to unprecedented levels to kill inflation. The economy was in recession. Savings and loans were failing left and right because they were caught in the same duration trap we see today. During that period, silver went from $6 per ounce to $50 in less than 2 years. Gold went from $200 to over $800. Those weren't gradual moves, they were panic-driven explosions as capital fled the financial system. We're seeing similar dynamics today, except the dollar amounts are larger, the leverage in the system is greater, and the amount of currency created over the past 15 years is unprecedented. The potential move in silver could make 1980 look tame by comparison, but here's what most people miss. Timing these moves is nearly impossible. You don't get a memo from the Fed saying, banking crisis starts next Tuesday, position accordingly. It happens, suddenly, usually over a weekend, when you're not paying attention. Republic First Bank was seized on a Friday afternoon. Depositors found out Monday morning. If you were waiting for confirmation before buying silver, you were already too late to get the best prices. Premiums spiked immediately as dealers got flooded with orders. That's how these things work in real time. The move happens before the mainstream media acknowledges there's a problem. By the time CNBC is doing special reports on the banking crisis, silver is already up 40% and physical metal is hard to source. The people who profit from these dislocations are the ones positioned ahead of the chaos, not reacting to it. If you remember one thing, remember this. Bank failures aren't isolated incidents. They're symptoms of a system-wide disease that can't be cured without destroying the patient. The unrealized losses sitting on bank balance sheets aren't going away unless interest rates collapse back to zero, which would require the Fed to abandon any pretense of fighting inflation. The deposit flight dynamics won't reverse unless the Fed provides unlimited backstops to the entire banking system, which would destroy the dollar's credibility internationally. There's no clean exit from this situation. Every path forward involves pain, either for banks, for the currency, for the economy, or most likely for all three simultaneously. And in that environment, silver becomes more than just an investment. It's insurance. It's a way to hold wealth outside a system that's increasingly unstable. It's a tangible asset that exists independent of anyone's promise or balance sheet. When Republic First Bank got liquidated, the depositors didn't lose their money because the FDIC stepped in. But the message was sent: your bank can disappear overnight. Your access to capital can be disrupted. The institutions you trusted can collapse without warning. Next time, will the FDIC have the resources to backstop every failure? Will the political will exist to bail out more banks after years of public resentment over Wall Street rescues? Will the currency survive unlimited money printing to paper over banking sector losses? Those are the questions that matter. And while the mainstream financial media debates arcane policy details, smart money is quietly moving into assets that don't depend on institutional promises. The silver spike is coming, not because I'm predicting it or because I want it to happen. It's coming because the math demands it, because the structural imbalances in the system are unsustainable, because confidence is a fragile thing that once lost doesn't easily return. Republic First Bank is dead. Others will follow. The pattern is clear to anyone willing to look at it honestly. And when the dominoes start falling in earnest, when the contagion spreads beyond regional banks into larger institutions, when the Fed is forced to choose between saving the banks or saving the currency, that's when silver disconnects from its paper price entirely and trades based purely on physical supply and demand. At that point, the price becomes whatever someone's willing to pay to get actual metal in their hands. And in a banking crisis, when trust evaporates and paper promises mean nothing, that price could be shockingly higher than most people imagine possible. The setup is complete. The fuse is lit. What happens next isn't really in doubt. It's only a question of timing and magnitude.